So if you buy Guy's Windicator, you're probably asking, where's Wynn headed from here, right? Legitimate question. Let's go off the chart to Todd Gordon of Ascent Wealth Partners. Todd, where do you see Wynn going?
Hey, guys. So as Guy mentioned, there's definitely a bullish development. If you look at the long-term chart at Wynn, there was a pair of 80% declines into Guy's 47-degree day. It held support. It rallied. It's encouraging, but it's got a lot of wood to chop up around the 105. Generally, Guy said 109. So 105 has got a lot to prove. From a fundamental point of view, we just don't see it. I don't think it's kind of helpful as a reopening economy stock. It's very susceptible to U.S.-China relationships. Casino stocks like Wynn are heavily influenced by the Chinese government. There's a report that came out that gambling in Macau, I think, is 7 times larger than Vegas. 2 of the properties, 2 of Wynn's are Vegas, 3 are Macau. So I don't know. I just got a lot of debt. It's going to make it vulnerable. And, of course, its revenue would be susceptible to sort of looser regulations for online gambling. I think it's got something to prove still.
All right. So if you think, Todd, that Guy's Windicator is baloney, what do you see as the best indicator in the market?
I see something to prove. I wouldn't go, I'd call anything the great Guy Adami says is baloney. No.
I would.
No. Something to, sorry, what was that?
I would.
Okay. That's why you're the boss. So XLK, you know, I have to go with what's working. I love technology. You know, I think this economy, and I think we as a civilization were on a set timeline to become more automated, and COVID just accelerated. I say stay with what's working. The tech names are going to reinvent the way that we spend our discretionary dollars. I think it was going to happen anyway. So I like technology. I'm going to use it until it's not working. Our global growth portfolio is kind of focused on the technology and is reflecting it. So one thing that I would draw your attention to, kind of pulling back from only technology, is looking at the SPX RSP. RSP is the equal-weighted S&P ETF put out by Invesco. And what's interesting is a lot of people are saying the rally's getting very thin up here. But if you look, the RSP-SPX ratio has moved up sharply since May 10th. And that's sort of indicating that we're getting a broad-based rally. The RSP and the SPX have gone into a little bit of consolidation, right, while the NASDAQ has taken another leg higher. So I think the rest of the market's kind of taking a breather, so I'm continuing to stay bullish. And if we have time, if you take a big step back and look at all the rallies that have ensued since the credit crisis low of '89, I think it was like 82%, 87%, 64%. We've seen 3 pretty significant rallies. Guys, we're just 42% from those March lows. So, you know, I think we have more room to go. And if we're using history to predict what's going to happen in the future, a 64% rally puts us at like 3,600 in the S&P. So we're continuing to remain bullish.
All right. Todd, thanks. Good to speak with you. Todd
You guys too.
Dan Nathan, I don't know if you have thoughts about the Windicator or if you've got your own.
You know I have my own, Mel. I have the J.P. Morgan indicator. Ticker is JPM. That's how that one comes out there, Guy. You know, listen, this is one where it's still down 30% from its highs. Yeah, it's up 30% from its lows. You know, that is a relative underperformance there versus the S&P, versus the NASDAQ, versus everything. And it just doesn't act well. And I think, you know, what the bank stocks, the money center banks in particular, are telling you is that we are going to see, you know, higher defaults, higher levels of bankruptcy. We're going to see possibly a commercial real estate crisis in the second half of this year, early next year. And to me, I think the direction of the banks, you know, they've come in pretty hard. Guy nailed J.P. Morgan. When it was $90, he says going to 115. Well, it stopped on a dime at its 200-day moving average, and now it's back below 100. So to me, I just don't think you want to see this one breaking 90 anytime soon. It will not augur well, as Guy likes to say, for the broad market, in my opinion.
Karen, your thoughts on the J.P. Morgan indicator?
Morganator.
Well, I mean, you know, I'm long. I love J.P. Morgan. I love Jamie Dimon, but it doesn't act well. And I've thought for a long time that there is a disconnect between the broader market and the banks, the money center banks. And, you know, we'll get a lot more clarity on Thursday when we see the stress test. And I don't believe that J.P. Morgan will cut their dividend.
And Tim, just quickly, you're looking at transports, the old Dow theory.
Yeah, I mean, I think it's important. If you think about the transports, and so the the IYT as measuring the entire sector, including the rails and FedEx as heavyweights, basically double top back in 2018. A lot of this was trade war. That's where we saw, I think, the peak of truly the economy, and where we actually saw economic growth that was becoming very well-rounded and starting to thrust into high gear, and then we lost it. So I want to see the transports come back, and at times in this point, Dan's right to bring up the banks. I think the transports are more important when talking about the breadth of the economy, and yes, Dow theory has proven to be important. It's not the only rule, but transports have still lagged. We need to see transports catch up.